Welcome to Let's Chat, the show where we talk to CPAs and lenders, some of the best business brokers around the world, and other professionals that can help you. My name is Jim Parker. I specialize in selling businesses that have gross sales between 1 million and 10 million. Fellow business brokers, I appreciate you joining us today. I'm really excited because we got Mike German with us. He does quality of earnings reports. And, as Main Street business brokers, we don't come across quality of earnings very often, but once in a while we do. And I think it's important that we all have a better understanding of quality earnings. Mike, welcome to the show. I appreciate you joining us today.
Oh, glad to be here, Jim. It's good to see you again.
Oh, absolutely. Hey, Mike, tell us just a little bit about your company.
Sure. Guys, so Hollywell Partners is at the end of the day a fairly large group of nerdy accountants. We do three things. We are a registered CPA firm, but we don't do tax and we don't do audit. We specialize in what's called quality of earnings, which is non-attest diligence, a very good shake of the trees for M&A transactions, both on a buy and sell side. We've got about 50 people around the country now cranking them out, mostly Big Four, former audit and deals professionals that can do this on a remote basis, and then on-site field exams and on-site physical verification of assets that's needed. But it is a very good way to get at least some level of financial comfort over smaller deals and even big deals. Even sometimes with audited financials, companies still ask for QOV to get focused on operational metrics versus financial statements.
No. All right. Awesome. And I got to say that you and your company and myself, you guys did a QOV on one of my transactions that I closed on at the end of last year. And I was the listing agent and the selling agent, had both sides. And obviously the buyer had hired you guys to do the QOV. And I got to tell you, you guys were absolutely fantastic to work with. You really were. Got a great company.
That's good to hear.
And that's all you guys. I'm sorry. Go ahead.
No, go ahead. Go ahead, Jim.
No, as I said, so that's all you guys do is you guys just do QOV, right?
So quality of earnings, and then we do a bit of tech. So our bread and butter is private equity and VC roll-ups for our larger QOVs, so meaning larger transactions. And then for small and medium-sized businesses, deals that you guys focus on, it's what our QOV Lite offering is. It's a smaller, condensed version of the shake of the trees with a focus on P&L and working capital. But outside of that, it's a lot of technical accounting, fractional CFO and controller work, and then a bit of white label audit and deals work for the bigger firms.
Yeah, that's great. And business brokers out there, you're listening to this. If you do come across a situation where, the buyer's ordered a QOV, don't panic. It's just it's a great process for a buyer to make sure that what they're buying is great. So I want to know what kind of sizes you work with, Mike, and like you're talking about light, like what size deals is like your regular size deals, and what size is like your light, and what are we looking at in those terms?
Of course. So full quality of earnings, we do upwards of top line revenue of $250 million or so. And that's probably the high end of where we go. Outside of that, it's usually a bigger firm or one of the Big Four and all the way down to something, you can do QOV full for something 10 million plus, but QOV light is really geared towards the sub $25 million asset and sometimes equity deal. Because you don't need all of the additional balance sheet and additional years focus that a bigger deal would need. So QOV Lite is geared really to that sub $25 million deal space.
When you say 25 million, you're saying an enterprise value or gross sales? Gross sales, right?
It can be either.
Okay.
Again, it really is just geared towards smaller transactions. So small to some people can mean different things, but that $1 to $10 million space that you focus on, Jim, is very much tailor-made for a QOV Lite assessment or a financial diligence.
Mike, it's funny. The relative size is interesting because you're like, yeah, the smaller transactions we do all the way up to 250 million, and we'll go all the way down to 25 million. I mean, 25 million for the regular, and you're like, yeah, that's smaller. And then the smaller sizes, and our definition of big and small to us, a $25 million deal is pretty large.
So, and let me give you a little bit of background. So QOV Lite was born out of a conversation with a small business broker and an attorney friend of mine, where they said, we're getting a lot of work now because a lot of small deals aren't getting any kind of diligence done. They're skimping because A, the regional and national firms are too expensive, and B, they don't think they need it. Well, once you sign and fund, as well as you and your team knows, Jim, it's hard to get out of it if it's gone the wrong way or if something was lied about or just an error. A Q of E Lite is very cost effective in its assessment of the business, and it gives you at least something to back up in your LOI. I'll get off my soapbox, but that's why Q of E Lite was born.
Don't get off your soapbox. We want you on your soapbox. We want to hear all about it. So what really is the difference between like a regular due diligence and a Q of E situation?
So Q of E is a fancy marketing term for financial due diligence, but it is tailored specifically to a transaction, whether buy or sell side. Buy side, you're trying to get as much information as you can to make a relevant investment decision, and sell side becomes accounting cleanup and a very good addendum to a pitch deck, a sim, or just a one page or glossy, depending on the size of the deal. So at the end of the day, it's really non-attest financial diligence. So we're going to do the same things that we would otherwise do in an audit under AICPA rules, at least to some extent, in a Q of E, but you're not getting an opinion. But at least you've got well-trained, highly qualified CPAs putting some numbers together, doing some core testing procedures, which include cash proof, detailed revenue testing, reconciliations to tax returns, among others, but those are the key hot button items that we focused on early to give you some comfort that the numbers being published on the sell side, if this is a buy side transaction we're being engaged for, are somewhat reasonable for you to make an investment decision upon.
Okay. So it really is just a fancy word for due diligence, quality of earnings. I mean, you guys dig a little bit deeper, right? Or no? It's just a fancier
Well,
word.
due diligence itself is a vague term, right? So
Yeah, it is.
that's
That's true.
a great point to bring up, Jim, and not to belittle other providers or what. So if you get a Q of E done and it's just someone putting the financial statements together in a shiny report, that's not diligence. That's just a shiny piece of paper to give you something. Make sure you get some testing done. So, for example, the cash proof, the first test most providers do, and in fact, one of the first things an audit firm would do if this was an audit engagement, is take opening accounts receivable plus revenue recorded minus cash received equals ending AR.
Mm-hmm.
You don't need to know any of that. All you need to know is we're going to vouch out independently against bank statements as to what revenue was recorded to see if what they're saying from an operating cash flow perspective is actually getting received in the door.
Right,
because at the end of the day, cash is king. Following the cash and following taxes, what people are willing to tell the IRS, is a pretty good indication if we can get comfort over those two numbers. Where if this makes any sense, if what they're telling you has any kind of legs or footing to stand on.
Got you. And I remember the transaction that we did with you guys. Part of that was that you guys went through, and can't remember, there was so much going on at that time with the transaction. But yeah, you guys, it was like 10 or 15 transactions that you guys really dug deep on. You just grabbed them randomly and you're asking for supporting documentation on those to make sure that, they were invoiced, they actually collected the money, and, I was just testing and it was all picked out randomly.
Yeah, that's an important. So that's after the cash proof. We take one step further, and although I'm sure this gives sellers a bit of deal fatigue, we do detailed revenue testing, meaning we take the full register detail, tie it out to the financials, and then to your point, haphazardly select a number of transactions to then vouch out to contracts, invoices, service tickets, depending on the industry, and payment support. Because we really don't feel like we know a business until we see their contracts, especially their revenue contracts.
Right. And Mike, it was really refreshing for me to work with you guys. A lot of times it's really hard to find people out there that'll do due diligence. Regular CPAs kind of want to stay away from doing any kind of due diligence. They're worried about the liability. And quite frankly, I don't know if they really have the expertise in what they're trying to really accomplish in a business transaction. So I'm really glad that you were involved, and I'm looking forward to working with you guys in the future. And believe me, for you guys that are listening out there, I'm not trying to sell Mike's services. It's a great company. Honeywell is a great company. Mike's a great guy. His staff that I worked with was excellent. This isn't an infomercial for them. It's just to get better understanding of Q of E, but we will be touching on that. So how much? I do want to let the audience to know this. Like for a QOV light, like what kind of cost are we looking at?
Sure. So the QOV Lite is very, in our minds, economical from a deal perspective. It's 10 to 20 grand. If it airs towards 20, it's because there's either more complex from an industry or company perspective, and we're doing additional years. If it's at the lower end of the range, it's not very complex, or we're only doing a recent amount of accounting period. So there's a range in there. I do want to make it clear too that we know cost matters, especially on the buy side, because every dollar going out is something else that could be spent on legal diligence, tax diligence. We know that we bill half up front, which covers a lot of cost for us. But let's say we find something, a red flag that you walk away from the deal from, you're not getting that second bill. You might get a small bill for time
Really?
incurred, but we
So
want you
so
to come with us. Go ahead, Jim.
I'm so sorry to interrupt you, Mike. So yeah, so it's 50% up, and then the other 50% is due after you get done. But if during that period of time there's something that pops up, kills the deal, you guys don't charge for that second portion.
No, it wouldn't. So, hey, we're not marketers. And to your point about go talk to all the other providers too, guys. We're not here to sell specifically
Yeah.
Hollywood. We're trying to inform you on Q of E. But we know this is a pain. It's a pain on the seller. But our job, although just to be clear, this is not in a test engagement to your point about liability, Jim, meaning we're not on the hook for liability, fraud, error. But the items we do find, which we find a lot, I would say at this point, up till last year, about a fifth of the deals that we looked at were walked away from because of something we found. I think that's trending up a little bit because with interest rates and everything else, people are a little more skittish. Either way, yes, we want you to come with us on your next 5 or 10 deals. And we think it's only fair on behalf of the buyers that we work with to make it clear that we're here to work with you, especially if we find something and it's a red flag. That's what you brought us in for to begin with. So.
Right, right, right. And I'm going to tell you from a broker standpoint. Well, first I want to say, you say 10 to 20 grand, and those people that are listening, 10,000 to 20,000 sounds like a lot of money. But I mean, if a buyer is acquiring a business for a couple $1,000,000 or more, it's really it's not very much money in the scheme of things to be reassured that what you're getting is the right thing. And then you said what, 20% of the deals fall apart because of what you guys have discovered during the
That's about
investigation?
the average. That
Yeah.
includes deals that are walked away for other reasons. So, sometimes deals just don't go through, but a lot of those that we find out about that haven't gone through is because something we identified and the deal just couldn't be retraded or negotiated. So,
What are like the more common things that you see why the deals are falling apart?
so without question, a lot of people look EBITDA is a very common deal metric, right, in anyone's network. So purported EBITDA from a sales side sim from a broker, I can say with almost certainty it's going to be lower when we actually dig into the numbers and do the adjustments because our job is to be prudent and the broker and the seller side is to get that number as high as possible. So that's a big one. Just flat out the number's lower than you said it was. We need to renegotiate on the multiple or whatever else. We're not here to negotiate the deal, but just misses on numbers.
Mm.
From a straight up deal perspective, we find a lot of things from employees that are not working that are getting paid, add backs that just can't be substantiated. For example, when a deal's been based on, hey, we're going to be able to let go of 25% of staff post close because of synergies or efficiencies. Well, you got to be able to substantiate that fact, guys. And then when they can't, that number comes down again. So, but those are the short list of items, Jim. We find all sorts of stuff. We flat out find fraud. People manipulate bank statements,
Wow.
PDFs, try to hide revenue or try to hide contributions from owners as revenue. People try all sorts of stuff to sell their business. We're not saying everyone's trying to commit fraud, but we find lots of stuff, just like we did in our old audit days with our big firms. People do silly things when they're trying to sell their businesses. And we're going to give you frequent communication, our view of tone at the top to see how these guys are operating. And then, one of the things that gets a lot of people, Jim, and it makes more sense now that I look back on it. When people refuse to give you things, and by the way, our list of requests is very standard. There's nothing unusual or scary in there.
I didn't think it was outrageous.
That's a big red flag.
Yeah.
It's not. And we get we've gotten a lot of refusals the last 6 months. People just not willing to share some things. And we're not talking about sensitive stuff. either
You're not
because,
talking things like
well, we don't
client
really
lists
know.
or
We
anything
have
like that. You're not talking about like client
no,
lists or
we're
anything like
talking
that.
about basic. Mm-mm. And that can be a red flag too. But we can go. That list is so long. We could be here all day. So,
Yeah, no, absolutely. You know, Mike, and I think if I remember correctly, there was, and I don't think it was a client list or anything. There was some stuff that was kind of a little bit on the edge of being confidential in the transaction we did together, and we sent it
okay.
over to you guys with the agreement that that wouldn't be shared with the buyer. You know, and you guys have a reputation
Well, we're
to
willing to
uphold.
sign a separate NDA. Oh, and that's actually a great point, Jim. We'll be as discreet as the sellers or buyers need us to be. We understand not everyone knows about potential sales, and we're okay with redactions. We will work to get this done together. And by the way, we're not here to get the seller. We have kickoff calls where we make sure that they know we're not here to
Yeah.
audit them. We're not the IRS. This doesn't go anywhere else other than between parties. This is not. We're not going to externally report anything. In fact, we're under strict confidentiality not to do so. So
You know, you talk. I want to go back because you were mentioning that. You know, when I asked you the question, what do you see the most common reasons why deals fall apart? You had said that one of the things is that the broker's job is to try to increase the, you know, discretionary earnings or the adjusted EBITDA number as much as they possibly can. And, you know, that's what I do when I get the financials. I'm looking for those things that we can add back. But, you know, I think for my fellow business brokers out there, you know, and I think the more seasoned brokers know this. When I'm going through and I'm doing my ad backs, if it's something that the seller is saying that they are running a certain expense through the business that's not needed, if it can't be proved during due diligence, I'm not adding it back because 50% of the deals that go under contract, and this is crazy. I would hate for this to be how my practice runs, but the national average is that 50% of the deals that go under contract fall apart before they get to the closing table. And, you know, so when I'm doing my ad backs, I'm keeping a very, you know, very conscious about the situation that we're going to be going through a due diligence period, and those financials need to, you know, we want to get through that. So I'm not adding back things, and I don't think brokers should be adding things back that cannot be definitely approved during the due diligence period. And I also wanted to say this to my fellow business brokers out there. I know that you're like, wow, 20% of the deals that Honeywell does fall apart because of things that they may have discovered. I don't look at that as a negative thing. I
right.
really don't, because for me, it's like when I'm talking to a business owner, you know, I'm very selective on the businesses that I take to the market, Mike. And when I'm talking to a seller, I'm thinking in my head, I have kind of a checklist of things that I'm looking for. If my team really wants to invest his time and money in taking this business to the market and getting the business sold, and one of those is the likability and the trustworthy of the seller. And I've actually turned down really good businesses that wanted to list with me because I didn't feel comfortable with the seller. And at the end of the day, the last thing I want is to be involved in a situation post closing where that business was not what the seller was claiming it was. So, you know, if somebody came to a company like yours, a buyer of mine came to a company like yours, and they got kicked out because the deal fell apart because of something that you guys discovered, I want to know that as a broker too. You know what I mean? Like it's about doing things ethically, and I want to be able to sleep at night, and I want to stay out of legal trouble, and you know, and you know, at that point, you know, well, I think I'm get off my soapbox now.
Hmm.
so, we talked about the size is $250 million and under. Can you kind of explain the process of assessing the quality of earnings report or doing the report?
No, of course. So stage one is we have a very standardized engagement letter. Looks like any other professional services engagement letter. Comes along with the request list. And we ask that we're talking buy side. Sell side is a little different. Buy side, engage with this potential buyer, send them a request list, and we ask for a warm introduction with the seller and their broker, if there is one, to then take and run with it. So we tend to step in the middle and be the bulldog on behalf of the buyer so that they don't have to be tracking down requests, asking the relevant questions, asking the tough questions, handling kickoff calls, walking them. You know, we're here to help and correct things as much as possible so that the buyer gets a relevant picture of. So we want to keep the the relationship between buyer and seller as strong as possible. So we are happy to be the bulldog slash bad guy. The average turnaround on the QOV Lite is about 3 weeks. So well inside most people's diligence periods on an LOI, but I would encourage you to get engaged the second your LOI is signed because there's a countdown there.
Mm-hmm.
And then from that perspective, we'll provide the draft report to the buyer, assume any of the red flags that we communicate along the way aren't deal breakers, for review and comment, and then we finish up. And then I just want to make it clear, our fee does include Q&A with any potential syndicates, loan stakeholders, through to close, assuming they're not completely over the top onerous. We understand there's going to be questions that come out of those conversations.
Interesting. Okay. This is a weird question. It's something I thought in the past, and maybe I'm way out there. I can't believe I'm going to be saying this in front of my business brokerage community, but something I've been thinking about in the past, and tell me, Mike, if I'm crazy for even thinking about this, but has anybody ever done a QOV with you guys before they had a buyer, like the broker and the seller, so that they can go to when they're marketing and they can say that we've had a quality of earnings done, or is that just not appropriate? Or what's your thought process on that?
Sell side QOV is big with big transactions because their audited financials supported by a very pretty shiny QOV that says here's the additional metrics that you care about. Small SMB sell side work is picking up. So I would say we look back at our last trailing 12 months and we did about 110 transactions. About 21 of those, I think it was 21 or 22, were sell side on the small side, meaning QOV Lite for sell side. So yes, you're getting ready to sell. A lot of times it's brokers going, you guys are great. I think you're ready to sell too. It's the time to sell. Your accounting is not in good shape. There's a lot of holes here. Hey, call Hollywell or call whoever. Get this cleaned up. Get it. So basically, a sell side QOV Lite is generally a lot of accounting cleanup and then a nice shiny. It's the same report. It's just it's got a different focus. It's going to go to potential buyers as part of the SIM or glossy as an additional addendum to say, hey, here's where we've gotten a bit of an independent check on our numbers and some things recreated. So, it's picking up.
Well, Mike, you make me feel better because I thought that, you didn't laugh at me, which is good. I didn't realize that
No.
You were getting a decent amount of smaller. I knew the larger transactions I might do it, but I was surprised to hear that, a lot of smaller transactions are doing it now. I mean, from a broker standpoint, it's a lot of time and a lot of money. I mean, if you're doing it right, I know some brokers that don't think it's a lot of money when you take a listing, but I think if you're doing it right, there's money that's involved and obviously a lot of time involved, from, preparing it to go to the market and then pre-screening the buyers and, handling buyer seller calls, negotiation, everything. I mean, by the time you get the business under contract, you could have a couple hundred hours into the transaction already. And then, during due diligence, boom, the thing blows up and pops out. I mean, we look at tax returns, we're looking at things, but we're not doing a deep dive as brokers. We're doing more of a surface thing because that can't be our responsibility to do due diligence of any sort, but on the business for liability reasons. But gosh, if there is a problem, I would rather know that up front before I spend a couple of hundred hours, working on that transaction. So that's pretty cool that you guys do that, Mike. Seriously, I'm going to really highly consider that.
Quite a bit. To your exact point, a lot of times it was coming to us because the business has tried to be sold a couple times, and it's a great business and there's value there, but their accounting was so terrible. The broker eventually called us and said, "Can you just clean this up for us and get us a nice report because we think there's value." Anyway, we're on the same page, Jim. I think it's something people overlook, and it gives you basically a data room ready to go. So
yeah, and I would imagine that would be a huge selling tool to buyers as well, the buyers that are interested in the business, to say, hey, that Honeywell already did or somebody already did a QOV report on this business. And
it certainly helps. We do see both sides happen at times too, a buy and a sell side QOV. Obviously, we can't do both. I mean, there's nothing precluding it, but it's not a good idea. It's two different incentives. But it does happen, and it's certainly that much more comfort if both sides are complete.
Okay. How many years do you guys go back when you're doing a QOV?
QOV full usually is a full 4 to 5 plus year to date or trailing 12 months, whatever month available. So, for example, right now, most are coming out at trailing 12 months July because August isn't closed yet. But QOV Lite is full prior 2 years plus latest trading 12 months, so July.
Okay. I got to ask you, Mike, how did you get into this industry? I'm sure it's not one of those things you're sitting in middle school or high school and going, "Now I'm gonna you grow up and do
So
QOV."
it's, I mean, I'm a giant nerd, so that helps too. But I was an Air Force captain turned PwC director. I started off in the SEC audit space. So a lot of our team comes from large, big firm audit, and at the end of the day, QOV is just it's really audit procedures without an opinion. So when I got into the transaction side of the house with PwC, working on some transaction work, quality of earnings was essentially pushed to me as, hey, you can do this, and clients will actually care about what you say because you actually, what you're doing for them is pretty real time and relevant. So it's a very it's a very natural transition if you've been in public accounting.
Okay.
So most of my team, in fact, all but two of them, I think, come from the Big Four as far as audit and/or transaction services work.
Okay. Now, you were talking about the deals falling apart. How do you address, potential accounting irregular, potential accounting problems or questionable transactions, things like that? If there is a problem, what's the steps you guys take?
So first thing we try to do is it's pretty easy for us to identify irregularities because all of us have hundreds of transactions and audit years of experience. Hundreds, and we're not that old, but I mean number of transactions and clients. So when we find them, we try to find root cause. A lot of times it's contract or just poor coding or just a bookkeeper that didn't know what they were doing. But ultimately, we make it clear, here's the issue, here's the potential effect, here's what they did record, here's what they should have, here's the effect on EBITDA or revenue or gross margin, whatever metric matters to the buyer, and then let them make the decision. But we give them all the relevant points. Because we're not here to negotiate the deal. To your point, we don't carry any liability as far as whether or not the transaction is valued at whatever. But those relevant deal points matter. So we try to give them a full picture of what was done, what the impact was financially to the metrics that you care about across all of the different issues we found. Usually it's more than one. And then here, it's your decision to be made. Either go make a retrade or you're happy to sell at this number. I should also make it clear, sometimes accounting irregularities go in favor of the buyer. That doesn't have to get disclosed to sellers, by the way. That is, we're here to contract on behalf of the buyer. If EBITDA happens to come out higher, that doesn't happen very often. It's often a good metric to say, okay, we certainly have found value here. But we're here to report on the information, Jim, not necessarily help them make the decision. But.
Okay, so you guys aren't even saying, hey, this is how much we think you should be buying the business for, right?
So because we're all old transaction guys and we have access to PitchBook and multiples, we know about where the businesses would fall out if this was in the open market. We're happy to give that information to you, meaning we'll pull comps, we do report on the IBIS World latest detail for industry reports because we have access to those databases, but we're not going to tell you this is the number. In fact, even when we did valuation in our big shops, it was always a range, right? The business is probably worth from this to this, but we actually give you no comfort over that because we can't. That's not how that works. Value is between a buyer and a seller and what they're willing to pay one another, right? So we'll give you the bookends. You go and negotiate on it.
Right. Okay. All right. Great. And then you guys, when you guys you're not giving any opinion on anything either. You guys are just laying out the facts of everything. I like that.
Correct.
That's really great.
That's actually an important part to bring up. Even if this was an audit, meaning we are a CPA firm, we were signing an audit opinion in accordance with AICPA standards. They're not on the hook for fraud or error to some degree either, right? So I just want to make that clear. Even if you've got audited financials, there's not absolute comfort ever in a deal. I hope everyone knows that, and I'm sure you guys coach your clients on this. But please note that there is no absolute 100% comfort on any client ever, because that's just not a thing. You'd have to spend exorbitant amounts of money to get 100% comfort.
Right.
Again, now I'm really on my soapbox.
No, you're not. No, but I think it just comes down to getting to the point where, you start to feel comfortable. You get to that range that you feel comfortable, Doesn't have to
Exactly
be
right.
100%. You don't have to come get it down to the actual dollar or anything. It's just getting to the comfort where, yeah, you're good. We're 95% there, or whatever it is. You were talking about metrics and ratios. Like, what are some of the metrics and ratios that you guys use to assess the overall, financial health of the company?
Ah, fine. So the big three: revenue, gross margin, EBITDA, and then adjusted EBITDA after add backs and non-recurring charges. Those are the big four, I guess. I think everyone we know gets reported on. But if, for example, if this was a SaaS client or tech, they care about customer acquisition costs, long-term value of the customer. So we give those relevant metrics. If it's an inventory-based client, we know that inventory matters, inventory turn, inventory obsolescence. Are they even recording inventory correctly or doing physical counts? For a manufacturer, those become relevant. So it's really industry specific outside of the ones everyone knows about. It becomes pretty important. For example, in retail or in restaurants, revenue, there's no need to detail test revenue because
Hmm.
it's individual point of sale, high volume transactions, right? But inventory and AP and long lead times on purchases matter, right? The flip side, everything in tech matters, and there is no inventory because it's all services and staff. So we do a lot more work around payroll registers, where they allocated the time. Was it in cost of revenue or was it in operate or SG&A? Because that matters to gross margin.
Right.
Everyone that says they're a SaaS company, but if you're not doing 90% plus gross margin, you're probably not a SaaS company, or at least not your revenue hasn't picked up. So we get as far into the industry specific metrics as the buyer needs, I guess is the point.
Okay. And what about working capital? Do you guys help identify the working capital needs or requirements of the business as well?
Correct. Even in QOV Lite, we give you DSO, DPO, working capital, and most importantly, working capital less cash because most times transactions are done on a cash free, debt free basis.
Yep.
So, yes, you will have the bookends depending on the DSO or how long it takes to turn receivables into cash, how much cash float is needed to keep the business steady for then to go negotiate, assumedly for your broker's perspectives, the working capital peg or how much working capital needs to be left in the business or held back. However, the deal is negotiated, even a QOV Lite that we do gives you the relevant bookends to go and start those negotiations.
Mike, that's fantastic because I think that that's probably one of the hardest things, not on all transactions, but on certain transactions, is the working capital requirements for the buyer's going to need moving
Exactly right.
forward. And a lot of times, unfortunately, the sellers don't know. They're guesstimating, and that's gosh, that could be a couple webinars on its own on how to
Mhm.
determine working capital requirements. But that's really great that you guys do that as well when you're doing the light. Is there anything else that? Well, let me ask you this question first. Is there anything that you see that brokers do that we could do better so that if a listing that we take to the market ends up going to a company like yours and there's going to be a quality of earnings or due diligence or whatever, is there anything that you see a lot and you're like, gosh, I wish brokers knew this or wish they did this?
So like for example, the fact that you've already been through tax returns and some of the basic financials is really positive. Our biggest pet peeve, I think, is when we get a broker that has done no gut check on any number and basically has said these numbers, these documents can't be recreated. Of course they can. There's a CPA usually involved, depending on the size of the business. I think the one thing that would help, and Jim, I'll send you our request list, and you can send that out to your broker community and say, if you can put together 75% of this, or at least have them, the sellers, pull this together, it will make it'll make everyone's lives easier if
Right.
this is set up and ready to go day one. Because our basic QV light list, everyone's going to have that same list. It's not Hollywell rocket science. It is a very standard list of asks that everyone's going to ask for. That brokers should be aware it's coming, even if there's no QOV done. If someone's got some financial ability and has looked at accounting records of any sort, is going to be the same list. So if you could get that out and say, make an effort to get this done, or at least know what these are, it'll go a long way to speeding up the transactions and hoping improving percentage to close.
No, that's fantastic. All right, great. Appreciate that. Is there anything else that you think we need to know? We should know as brokers out there, or anything else you want to say about your
No,
company? Or...
thank you. Glad you guys are out there. I mean, I one thing I will say is when companies don't show up with a broker, brokers are important. Like when people try to forego real estate agents, not a good idea, guys. Use your brokers. They know what they're doing more than even the people that are astute in this business. You still want someone on your behalf, at least operating on your behalf.
I appreciate that, Mike. I think brokers play a vital role in the sales process. Obviously, I mean, especially when the stats that are out there that only 10 to 20% of businesses for sale actually sell. And let me rephrase that: a quality business broker, because just like any industry, you've got the elite, and then you've got the good, and then you got the average, and then the bad. And as long as you're dealing with a broker that's knowledgeable and experienced and know what they do, it's a game changer. Not only in maximizing the sales price, which obviously that's what brokers try to do, but increasing those chances of the business selling. 10 to 20% is ridiculous. Right now I'm selling about 90% of the businesses I take to the market, and the ones I don't sell, it's usually something beyond my control. Like I had one earlier this year, listed the business for sale. Mike, it was a great business. And then the seller was kind of checked out already, and his numbers over the next couple of months just went like that. And, it just killed the whole thing. Or, seller not disclosing something or something like that. And that goes back to really
tons of reasons things don't happen. But if we're able to maximize the reasons they should help.
Yep. Yeah, and that 50% that falls apart national average, that's just crazy.
I didn't know that. I didn't know that was the case. That's good to know.
Yeah, there was just a market pulse survey that came out. The results came out from the IBBA, and they asked brokers around the country questions, and it was literally 50% of the deals fell apart. I just, it's you're always going to have a situation where deals fall apart. I mean, things fall apart for the strangest reason. But if you're at 50%, I think you gotta reevaluate the way you're doing things. Because to me, that's part of what we're trying to do as business brokers, Mike, is be in a situation where we're thinking many steps ahead, kind of like you're playing chess. Like the way I just use this in another webinar, how I play chess. If I was playing chess with you, Mike, I'd make a move. I'd wait for you to make a move before I'd decide what my move is going to make. And that's obviously the most horrible way to play chess, because a good chess player knows all their moves like 10 moves out. Sure. But in business brokerage, when we're selling a business and we're taking to the market, we've got to be thinking all those steps out, and thinking about what obstacles that we're going to be facing when we're taking the business to market, and how we're going to overcome those obstacles. I know I'm getting on my own soapbox, but I think that's important from a business brokerage standpoint. Like one seller I'm talking to right now, they've got 3 business owners, 3 partners, and there's only eight other employees. And I said, before we take this business to the market, we got to do something about this high owner concentration, because a buyer's going to look at it and go, 3 people are going to be walking out the door 30 days after closing. Is a brain drain on the company. So, the company is going to wait about 4 or 5 months to take the business to the market, and they're going to be replacing one of the owners. We've got a whole plan ahead, but that's the kind of things that we need to be looking at. It's not going to get sold, or it's going to fall apart. So,
without question, and we see that a lot in professional services. So,
anything else you want to talk about to the brokers?
No, I really do appreciate you, Jim. I love talking shop like this.
I do too. I really appreciate you taking the time out to chat with us. How can people get a hold of you, Mike?
Oh, fine. It's HollywellPartners.com, guys. It's HOLLYWELL. Mine's Mike German at Hollywell Partners, and come find us. We're here to help.
Fantastic. Thanks a lot, Mike. And hey, my fellow business brokers that are out there listening, if you're getting any value from this at all, from the Let's Chat show, if you don't mind, please take a second, like the video, maybe comment on the video, and love for you to subscribe. And that way it helps me, and it'll help you guys as well, to make sure that you guys see more videos as they become available. So till next time, I'll see you guys later. Thanks a lot.
Thanks, Jim. Bye, guys.